Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Adam Whitlam, head of our Toronto Rate Sales Desk. This week's episode is titled Dire Straits.
I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated.
Welcome back, Adam.
Thanks,
Ben. It's been really long since I recorded last, so that as well. Apologies to the listener base. I'm between traveling and war and not knowing exactly what to say, and I guess that the lack of conviction on things kind of pushed the podcast to the side. But back now, and hopefully we can provide at least a little bit of clarity or insight, at least as to what's going on in Canada. At least.
It was pretty quiet. You didn't miss much. Yeah, it was a pretty calm month. Not much to talk about.
I mean, I was here for most of it, but I was in London last week, and there was some pretty good meetings there. Interest in Canada is still pretty strong generally, and I mean the fact that we only had a couple meetings canceled amid honestly what was chaos for the most part, and one of them was like super chaos on Monday, which was wild before North American hours. Pretty wild market moves, and only one meeting or two meetings canceled. I thought that was pretty good. That tells you that Canada is still an important topic for most people.
Yeah, it's funny you mentioned that because we've also been marketing. We have Lindgren coming to town. We had Francois Trehan in town, our new chief investment strategist. We had Mark McCormick, our new FX strategist. And I will say, in all my years here, I have never seen a calendar fill with requests for these meetings, presentations, marketing as fast as I have now. And I think that speaks volumes as to the thought process everywhere. And the account base, questions about where markets are going. I mean, we saw that in some of these unbelievable volatile moves where, in Canada, as they typically do, and they did in this bout too, things get unbelievably cheaper than anyone could possibly think that they could possibly get. Several rounds of stop outs go through, and yet still extreme reluctance for accounts to jump in and get long at some of these wides because you never know what's going to happen next. I mean, to be honest, we're recording this podcast on Wednesday afternoon, but we should basically give the time because the headlines are coming out
just before 3 o'clock.
So fast and furious that something we say right now could be totally invalid in about 5 minutes.
Which was part of why I haven't recorded in the past month, because things can change so quickly. But it also, I mean, your anecdote about calendars filling just kind of reinforces for me that, quite frankly, nobody knows anything. Like I mean, you read a lot. I read a ton of stuff. There's nothing definitive at all. No one knows where this is going. I read over the weekend that the risk for oil prices is that they go to $200, and there's a big long Bloomberg article with a whole bunch of reasons why we're underestimating the impact on oil, and the markets are asleep at the wheel and blah blah blah. And yet, oil prices are down today again, and you've seen the Brent and WTI basis has tightened as well, which I think is notable. There's a couple of lessons there, but the fact that Brent has pulled back as much as it has, maybe the supply is not quite as bad as people thought it might end up being, or demand's fallen enough. I'm not really sure, but maybe not as dire as people think. And that just reminds me that nobody really knows. This can go any way because any kind of headline can come at any time and change the whole market dynamic pretty much immediately.
So why don't we given that you were just in London, and I think a lot of our listener base would probably want to hear an update about this, what were the overriding themes from the international accounts with regards to Canada? I mean, probably the biggest discussion you have every single day is with regards to the Bank of Canada and what they're going to do. And is it possible for them to actually be hiking rates this year? I'm sure that came up in all of your meetings. Why don't you give me the gist of what the biggest topics or areas of concern were for some of the international clients?
It was mostly front end. So most conversations started in the front end, and that took a good chunk of the meeting. Whether the bank could hike, and invariably after I went through all the reasons why Canada, just super unlikely that they could be hiking anytime soon for various economic reasons, soft data across the board. This week's GDP number was actually much better than expected. Q1 looks way better than we thought it would be. Still not strong per se, but not super weak either. And inflation coming down, labor market soft, USMCA still overhanging. So lots of reasons to be negative on Canada on the macro outlook, at least. And so those reasons, and the fact that Whitlam told us during the press conference that if not for the oil shock, they probably would have been talking about cuts, whether it's at that meeting or the next meeting or at some point. That's just the direction that they were leaning, absent the oil shock. I mean, that's meaningful. I think that's meaningful. So that was how every meeting pretty much started, me doing that little spiel. The question that invariably came back pretty much every time was, okay, that's nice. We don't disagree, but what could make them hike? And the answer that I kind of iterated to, it probably took up more than one meeting to get there, but apologies to the first couple, would be breadth of inflation. And they told us that they would look through the first round effects, the initial move in energy prices. But if it broadens to other parts, other categories, other goods, other services, then they'll start to get a little bit more uncomfortable with that backdrop. The thing is, it's going to take months for that to figure that out. I'd say it's at least 3 inflation reports minimum, which then takes you into July. So depending on what you think on the conflict and how long it'll last, if it goes until June, July, then I'm a little more sympathetic to them maybe being forced to push rates higher. But I don't think that personally. And if it's going to take 3 reports and the conflict's not going to last that long, then this really is transitory and they will not be reacting to it. All that being said, and last week pricing was like there were 3 to 4 rate hikes for this year. So that part's important. So in that environment, especially when Canada and Europe kind of had even pricing or close to even pricing, that made no sense to me. Now we're down to like 1 2/3 to fully 2 hikes. So kind of like 40 to 50 basis points in hikes being priced. That's a little bit closer to where I think it should be. I think fair value is probably like a reasonable spot to end up is probably somewhere around 1 hike. Mm-hmm. And the only reason for that is because you probably want to keep some optionality around maybe that inflation is a little more persistent. And 2, if you do get a resolution on trade, like let's say the war ends whenever in the next few weeks, you still have USMCA hanging over Canada. But if that uncertainty goes away and we get some kind of deal that's not terrible for Canada, it can change the economic fortunes of Canada pretty quickly. Like growth will flip pretty quickly, I suspect. You'll get a lot of pent-up business investment come through. Maybe not all of it there, but you'll get a decent chunk and consumers will feel better. Like it is holding back a number of sectors. And that can change the backdrop for the bank pretty quickly. And you get like a seemingly 1 to 2 quarters of above potential growth. If that's what the bank starts to project, the output gap closes pretty quick. It's not huge in the first place. And historically, when the output gaps had 0 in it, so in the range, the bank has a 1 percentage point range. When 0 is in that range, they tend to look at raising rates. That is not that far away if you look at the last NPR. So pricing is still a little bit cheap in the front. Like there's still room to rally a bit more. It's not as much of a no-brainer as it was before. The risk reward's not nearly as good as it was last week, but there's still room to go.
I mean, a good question there is like if you contrast it against U.S. rates. I mean, our neutral rate, I mean, when we're sitting where overnight rates are in terms of a neutral rate, we're probably still at or even slightly stimulative with where overnight rates are right now. Contrast to the U.S., I mean, neutral rates in the U.S., at least according to the dot plot, are probably somewhere like, 275?
Slightly restrictive.
Yeah. So the U.S. remains slightly restrictive. If I was going to take maybe a long position in the front end, I think I'd actually be more skewed toward the U.S. Okay. Now, the only argument, the hard part here is, right, they've got the dual mandate and they're still running unemployment at 4.4%. So the UR in the US is quite low, especially relative to Canada. I know it typically runs lower than Canada anyway. But if I had to pick between the two markets and I'm looking at the Canadian market, which is slightly stimulative, I think I'd actually prefer to put that expression on probably in the US.
Yeah, I don't like Canada US for the like it was more Canada Europe was the trade because the ECB is more likely to react to energy and the Bank of England is more likely to react to energy than Canada. And you are eventually going to have probably a more dovish Fed chair come in the relatively near future. And the starting point for the Fed was important too. Like the market was looking for cuts. And then you went to like
now it's 0.
Some amount of hikes, and now you have a little bit of cuts left back in. but on a relative basis, there's more room for the U.S. to move than Canada, assuming there's not a super negative outcome on trade. Definitely, I think the U.S. would be more attractive from that perspective.
And I mean, conversely, or I guess in addition to this point where we're talking about rate differentials, I think dollar Canada, there's one where we've clearly seen a risk-off bid to U.S. dollars, which has really moved dollar Canada up back toward 140. I think that is mispriced by 10 points. I mean, especially if you have diverging central banks where, if the Canadian central bank, there's a propensity for some hikes, and the U.S. is probably leaning toward more cuts, not to mention, we know our economy is a resource-based economy. There is still demand for these resources. There are lots of reasons why the Canadian dollar should outperform from here. And so that's one that really stands out to me as Canada being too cheap here.
I'm hugely bullish Canadian dollars. I was bullish before this. I'm still bullish during this. In fact, this whole episode makes me even more bullish than I was before for all the reasons you cited. Like, Canada is a safe supplier and reliable supplier of any resource you want, pretty much. I'm sure there's a couple things we don't make, or can't dig out of the ground, but I think we got most things in Canada. And I think if you're a European country, you should be looking at Canada to, I don't know, as a natural gas supplier, LNG, maybe on the east coast of Canada, whatever it is. All these things are potentially very positive for Canada. USMCA still matters. I think that was already a cloud as it was over Canada, which has been restraining the currency just because of the tail risk there. But for now, it is a flight to quality. The dollar is bid, and when the conflict ends, that will flip. And then we'll I figure, go back to where we were, which is the prior regime, which was just kind of grinding dollar weakness, big dollar weakness. I think that's where we end up. But for this bid, the FTQ bid could last a while. Like, even when the conflict ends, you still might have some lingering.
It might be over in 6 hours. It might be over I think at one point, I'm pretty sure when the Bush administration declared that the war in Iraq was over, it kept going for about 15 more years. So
yeah, you never know. I'm going to be a little less extreme than that.
Those are your goals.
Probably weeks. Probably weeks from my perspective. It's hard to believe the U.S. wants to have gasoline prices at $4 anywhere close to the election. And as much as maybe they can't fully control what's going on, I think they'll do their utmost to ensure that this is not the reality for an extended period of time, because that's unambiguously negative from a voting perspective, and everybody likes to win.
So that brings up a great point about USMCA renegotiations. You can't just leave the Strait of Hormuz as is. You need to have some sort of deal, or you're probably leaving too much power in the wrong hands to squeeze oil prices when it suits. So
correct.
Assuming that the negotiations for some sort of deal actually do take a little bit of time, say they roll into the USMCA negotiations kick off and have to be done by June.
Well, they're already talking on the USMCA stuff. Like, US and Mexico are further ahead than Canada and US, but the talks have already started. They'll continue. It's like a fake deadline is July 1 when it officially opens, but they're talking now. It could be done by July 1st. It could be done by August 1st. Because when the way this deal is structured, it kind of reopens each year, or is open each year for renegotiation if you don't come to a deal this year. The reality is it's always open for renegotiation. Like, they just might take a year, might take a month, it could take a few weeks. I don't really know. I lean toward the shorter rather than the longer, but that tells me that, like, there's no real deadline when this has to get done by. Our head of fixed income suggested this could get done by July 4th, when it's the US's 250th anniversary. You get a whole big party in the U.S. Trump wants to make a big deal out of it. That's fine. You want to have a big party. You can declare victory on that too, even whether it's good or bad for the U.S. You can declare victory either way. And it does set things up for better growth going into the midterms. It's going to take a month or two for growth to ramp up on the back of any deal. And so a deal would also be positive for the U.S. And so it would make sense that that's kind of a timeline. That July 1st timeline actually does kind of work for like a deal just for that reason.
Well, I wonder, like, if the negotiations take longer in Iran, if it incentivizes the U.S. government to look more favorably on USMCA negotiations to provide price relief on some goods. I mean, if you have a really negative USMCA negotiation process, you're just talking about boosting prices into midterm elections on everything. So I think that probably doesn't serve the president's agenda all that well. So there might be some negative correlation on these two things.
Yeah, I think anyways. I think this whole event, again, like, if Canada's more attractive to Europe, it should also be more attractive to the US. having a supplier of anything that literally is right next door, and has very little uncertainty attached to it politically or otherwise should be a place you want to do business and you want to make a deal with. And so I'm still upbeat on all this stuff. I mean, I might be the only one. Apparently, most people are negative, or so it seems. Most people I talk to tend to be negative on USMCA. I'm the lone bullish guy, but my logic tells me that, like, if it benefits the U.S. and it benefits Canada to make a deal, and the reality is the irritants are that they keep mentioning are pretty minor. I mean, like, Canadian alcohol providers not willing to buy U.S. alcohol. Like, okay, that's not. I'm pretty sure we can overcome that one. Dairy, as much as it's politically a bit of a political football there, and you don't really want to make the dairy farmers angry. I mean, there's a deal to be made there, whether it's with higher quotas or not. Some of the other stuff would be transshipments is an issue they're concerned about. Goods going through Canada to take advantage of the tariff-free trade with the U.S. These are manageable issues. This is not existential for USMCA. So I haven't heard anything that's like a total no-go zone. We can't do this no matter what. That's just not where we are. The question for me is what happens to like the aluminum tariffs and the steel tariffs and the other tariffs. Lumber, I think, is going to be more challenging. That's a long-standing issue. That's not the same as the other two, but hopefully a bigger USMCA deal can also get some relief on those items as well, because those sectors have been hit hard, and autos as well. But I think autos is probably an area where Canada will have trouble making much ground. If anything, we'll probably have to give a bit more on the USMCA there, maybe slightly higher US content for cars made in North America to qualify for tariff exemption. That's certainly possible, but you put it all together, like, everyone kind of wants to make a deal. Why aren't we going to get a deal done? I don't know. And the headlines are the headlines. I get it, but actions are not necessarily reflective of the headlines. And the U.S. has exempted USMCA goods twice from the tariffs they've implemented. That's pretty notable. And again, the language that comes out of most of the trade talks is not that negative. They just want little things. At least what I deem to be little things. So I'm still hopeful there. That's where I am. I might be the only one, but maybe I just convinced a few people.
If we get a resolution on that front, plus we have this is also pertinent. We've got a couple of by-elections happening. The Liberals are slowly inching their way toward that majority.
Yep.
Carney's starting to implement some of the infrastructure spending programs that he was, the platform that he was elected on. So, you tap on a little bit of fiscal stimulus along with the USMCA negotiation that's going well, and like maybe the case for hikes from the Bank of Canada is not that far-fetched.
Not sure you're going to get much stimulus. That is the one. They already announced their and I still can't remember the name anymore, but it's the old GST credit, the grocery and whatever it's called, rebate or tax credit or whatever they call it now, increasing that as of July. So you get a big payout in July and then doubling it every year in the next 4 years. For me, like, that's the one stimulative thing you're going to get. I don't think you're going to get much else necessarily. That being said, that increase in the payout suggests there will still probably be an election. The more times I talked through it in London and talked about this side of it, the more I was like, oh, they probably actually will have an election. Even if the by-elections go their way, they have a majority. It'll be a one or two seat majority, not enough to really say that this is definitive. And the way they would get it would kind of not be cool, honestly. Like, people defecting from the other parties to give you a majority.
Oh, yeah, that's
not what people voted for.
No, that shouldn't be allowed.
Well, it's allowed, but it's not what people voted for. So it's kind of against the spirit of the vote. And so there's I think a decent chance that they call an election in the fall, assuming the trade stuff's kind of put to bed. And you can run on a mandate that we're running on Canadian sovereignty and Canada first and all this other stuff. And we're going to build all these projects. And I think right now they probably would get a majority.
Yep, I agree.
So I think it makes sense that they would probably still call an election just to help drive their agenda that much more. And so the stimulus side, maybe a little bit more going into an election. I'm not convinced, though. What we've seen so far on the fiscal side of things, if you look at the year to date on the budget deficit, it's in the low 30 billions for April until January, so 10 months of the year. The budget deficit forecast in the fall was 78 billion. You're in the low 30s with 2 months to go. So that being said, like, you keep in mind that there's always a huge deficit in March. They stuff a whole bunch of things into March.
Right. It
could be 20 billion, it could be 30 billion in the month. Like, you've seen some huge numbers in the past. So where we are, it does not necessarily mean they have tons to go, or tons of room, but I think it does reflect the fact that things are running probably better than they thought. They are running ahead, so there probably is room to do a bit more. But if they are going to run this election, you come out and you say, "Oh, look, the deficit's only 65 or 60. I'm a fiscal champion," and you have all this, the increased payments, and you have major projects offices making progress. All this defense spending,
projects, yeah.
all this stuff, and we still have all this extra money. We're better than expected.
Yeah,
and like that's a pretty good campaign platform to run on, I would think. And so I don't know how much more stimulus they want to put in, because it just, I think you'd rather have the better platform, and you want to save those bullets in case, let's say I'm wrong. It happens all the time. And let's say USMCA blows up altogether, US pulls out and it ends for whatever reason. You need to save your bullets for that, because that is a really bad scenario for Canada. And lower rates are only going to get you so far. And in that scenario, you need fiscal, and you need a lot of it. So
this is what the bank's been saying the whole time. You don't,
save your bullets.
Yeah, you don't fight. There's a lot of wars they don't want to fight by using overnight monetary policy rates.
Yes, correct. So that one's a fiscal one. You save your bullets. Don't spend them now when it'd be nice, but it's not essential that you do it now. Better wait.
So another question for you. Did, we're through the provincial fiscal year end. Today's the first day of 2026, 2027 provincial fiscal years. Did, credit spreads have seen a lot of volatility this year. I mean, I think, using Ontario as a proxy, we were plus 66 back at the end of January. Things got extremely tight, extremely fast. The street got caught short. Things went from 66 to 80 in a heartbeat over the next month and a half as a war broke out, etc.
2 months.
2 months. Were there questions about provincial credit quality, given that we've had larger than expected deficits from most of the provinces, larger borrowing programs? Were there any concerns on some potential negative outlooks for some of the provinces? Did that topic come up at all?
Largely not, actually. I think what the commentary around Provies and just credit in general, it was, in fairness, the conversations were mostly about Provies, but their intention of the comments were more general, that risk had held in really well, and spreads had actually held in well despite the ridiculous move in rates markets. And most were surprised that spreads weren't maybe a little bit wider. Risk wasn't even heavier than it has been. And so like pretty, I guess, not overly concerned on the fiscal front. Globally, if you look at it from a bigger picture perspective, the provinces don't run large deficits in reality. Like
very small.
1% to 2% of GDP is not huge, especially when the feds are in the kind of similar-ish ballpark. It's not the end of the world when the combined deficit's like 3% to 4%. One of the things that I think is worth investigating more, and I should probably do this, is looking at the kind of off-budget infrastructure spending, investment spending that they do, because that helps boost the borrowing program well beyond whatever the deficit is, and pushes net debt higher. And so that kind of, we look at the deficit when we're trying to figure out the fiscal state and how much stimulus there is, but we're missing that investment side, which is increasingly meaningful because you have a lot of provinces catching up from the massive population growth we had. And so when your population grows at like 3% for a couple of years, there's no world in which you can catch up or which you can build fast enough from an infrastructure perspective, especially when population growth is 1% for, 30 years, and then it goes to 3%. It's not like you automatically built enough schools and hospitals and roads and highways and subways. And so there's catch up now. That's what we're doing. All the provinces are like rushing, build as many things as you can. And that's good for growth. And you can see it a little bit in the data. If you look at the government investment numbers, they've been pretty strong. A lot of that's defense as well. So there's that aspect to it. But I think keeping an eye on the issuance for the investment side is notable too. It provides a good amount of stimulus.
How many times did the word referendum come up?
A couple times, I think. I mean, it's worth highlighting though. What's happened is the polls have gone the other way, and like
for Quebec, they have.
Yeah.
Absolutely. And which is exactly, when we talked to lots of clients about this is exactly what we expected. I mean, You had a situation where the Liberals didn't have a platform, so neither did the CAQ, and so the natural impulse at that point was that you were going to see higher polling numbers for the Separatist Party. Now things are much closer to neck and neck. We've seen Quebec spreads come back a little bit since. I was actually more thinking about Alberta, where there's definitely been some noise with regards to a referendum and potential separation.
Just noise. The appetite for anyone to leave Canada in this environment is pretty low on east or west for that matter.
Also, the bar is relatively high. It's not as simple as a 51-49 vote like it was during the first Quebec referendum election.
Times have changed. It's not that easy to do, and the appetite really isn't there. Canada has enough trouble dealing with other countries on their own. If you were to carve out a small piece of Canada and force them to do it by themselves, makes it even more challenging. Obviously, you have that much less leverage. I generally dismiss that as something that's realistic. The market might have to deal with it at some point. Admittedly, I don't think in Alberta's case, but in Quebec, there could be some fear there. But I don't think that's something that concerns me personally. A year from now, I bet Quebec spreads are tighter than where they are now.
Yeah, I'd be on the same page as that. I think probably want to look for an opportunity to buy them if there's selective headline noise and they push back out to back to plus 10, plus 11, plus 12. That seems pretty good. I mean, they've been quite a bit wider. They've been plus 20 during some of the referendum talks historically. And not personally, I'd be in the same mindset as yourself with regards to Alberta. I think, there can be noise, there can be headlines about a majority for a referendum to happen. But I think if you saw weakness in spreads there, given that we know how levered they are to the price of oil. And I do think, even if this war ends in the next few weeks, structurally enough infrastructure damage has been done in the Middle East that the floor for oil prices has to be higher. I don't know where that is, but it's 80 to 95. So if it's 80 to 95 as a floor price, that is going to benefit Alberta pretty significantly. So there's a province where you might want, I think it favors being long spreads, especially on weakness.
Yeah, I agree. Actually, that reminds me though, the province I think that probably has the most upside, I guess, downside in spread, Newfoundland. I think underrated province, good exposure to oil, hydro deals coming up. That's going to help as well, likely. Good. I mean, I think they've tightened a ton already, admittedly, from where they were a year or two ago. But I think there's still room to go there. The fiscal picture looks a lot better, and they export Brent, and Brent oil. Once the conflict ends, probably stays a little bit higher, I would guess, than WTI for a while. And so again, they do benefit from that. So Newfoundland looks pretty good to me at the moment.
I feel like we've said this on the same podcast probably a few times over the last 5 years. But hey, it's gone from plus 50 to plus 22 in the long end. So clearly,
I'm not sure that I have.
I think we can wave our flag here.
Some good things in Newfoundland now and again, but I think now they're the one province to me that stands out. I guess the spreads haven't moved to adjust for the oil move, whereas Alberta spreads have come in. Newfoundland spreads have not, and so that's notable for me.
Should we talk about some of the flows? I mean, I'd say on my side while you were gone, probably one of the more notable things was as we got I think at the front end, it was as much as 80 beeps from the richest levels. But as we got the massive sell-off across the yield curve, what I think was an interesting takeaway, and we're still seeing it now, was that the long end, even as we approached that 4% level, it was more challenging than I would have expected to find buyers. Now, I think some of that is sticker shock given the volatility and the speed of the sell-off and rates. But historically, over the last year, that 4%, 395 level in longs has brought in a lot of outright interest. We didn't see much of that. Now, we also didn't see from the LDI guys a lot of hedging activity happen sort of in the back half of 2025 and beginning of 2026. Some of that started to reemerge just very recently, but that was one thing I'd say is pretty notable. Also, the 10s 30s curve has been trading very poorly. It's been very offered the last little while. It's continued to steepen. The box, 10s 30s Canada-US box, kind of getting back to levels where Canada looks attractive again versus the US. And that's been more flow related, but those are kind of some of the questions that the clients here have been asking is why is the long end not performing better given the yield sell up?
I think about it a little bit differently. When I've been watching when I was in London, I was watching to see how high yields got in the long end. Where are 30-year yields? How far are they going? And the fact that they didn't touch 4%, let alone break 4%, which we've only touched once in 2022, and then before that, pre-financial crisis, 2010 and before, really, suggests there's support there. I know we've kind of the flow's been skewed to selling a little bit more, and we haven't seen the buying come in, but that we've still held that level. For me, that's probably more meaningful. That despite the lack of buying, we still held the level. So, I mean, my stop for any long end position would be like if we close above 4%, then I'd turn probably a lot more cautious. But as long as we can stay below that level, I'm personally constructive on the long end. It also provides you a bit of a hedge in case we get a massive amount of stagflation risk or something like that, because the curve will flatten a ton and longs will outperform in that environment, at least initially. And so I'm a little more constructive there. 10s, 30s. How did you want it to trade? Did you want it to? I mean, it in the big sell off, it flattened a ton with everything.
Mm-hmm. Yeah,
everything flattened, and that kind of makes sense when the risk is. It was like
futures are leading the way,
exactly.
And the belly leads the curve on a big sell-off.
And so now we've rallied back, and it's starting to steepen out a little bit, and you're getting some steeping. And that, I mean, it's April 1. You mentioned earlier, like provincial issuance is going to ramp up. We got 2 issues today. All the provinces are back in business, so like it's going to be coming. They're going to be tapping the market. I don't know, many times per week is my guess over the next few weeks. That's going to pressure the market. That's going to pressure duration. So like, that's my caution on the long end. That's why that stop is there at 4%. I think if you like, I like buying it like 395 in that ballpark, but like 4% is a reasonable stop, I think. But you're going to see some pressure there. I could see the long end underperforming a bit, while still holding under that 4%. So we can underperform the US a little bit and trade a bit heavy. And the curve probably does steepen because like, it looks like the conflict won't last much too long, a few weeks maybe. And as we get closer to a resolution and the market thinks that, you can see that rates are going to rally. Like there's too much price still, and that goes all the way out to 10s at least. And so you're going to steepen out that curve. But the opportunity is going to come. And the reason like steepening now is kind of a quasi opportunity is like, who knows what happens with the war. So I don't know if you want to take that risk, but let's say it does end and we steepen out nicely on supply and the end of the war. Then you're into kind of like May territory, and in May you got the 4 weeks to June 1
index extension.
Exactly.
This might be a new record for earliest index extension talk.
It's just you get that level of steepening, and you tend to have the seasonal flattening going into June 1.
Yeah,
like that's a great opportunity. Yeah. And on top of that, it's not just June 1. It's if you really are in any way, shape, or form like bullish on USMCA, the narrative on Canada is going to flip toward hike from weakness. Let's say cut's probably too far right now, but from a weaker Canada to a stronger Canada, that narrative flips on the Bank of Canada being like, oh, maybe they can hike this year, which is why I think the 25 beeps and for the end of the year makes some sense for pricing, at least, just to have that optionality in there. And when the bank is hiking or approaching that cycle, the curve flattens. And so you have 2 reasons to flatten 1030. So I think if we do get some steepening here, that'll be a great flattener to put on for a whole bunch of reasons. So there's been a lot less excitement about the long end, but I'm not so bearish as everybody else.
Yeah, that's fair. That makes I think
I changed your mind. That's it.
Yeah, I think that's I mean, structurally, I completely agree with some of the flows that you're going to see later in the year. I think maybe versus the US, like for a stab, for a trade, that range on the Canada-US 10s, 30s box has been very well contained. It's been -15 and -20, and it's really had trouble breaking that range. So
that's fair.
At -15, which is where it is right now, typically is a level where you want to put on a flattener in Canada. We've also gone from 36 on the 10s, 30s curve, 37 10s, 30s curve to 42.5, 43 very quickly. So I think, I don't think it's a mistake to dabble in putting on some flatteners there in the near term, but yeah, I think you make a good argument for why this curve could absolutely flatten. I mean, another thing I was looking at, even in the US, I was looking at forward inflation expectations, which in this, when we talk about like the propensity for rate hikes and whatnot, forward inflation break-evens have actually behaved very, very steadily.
No one thinks this will last.
Spot break-evens have gone ballistically well bid. So it just sort of says like this inflation is transitory and temporary, which probably means, maybe we are looking at potentially a flatter curve.
Yeah. I mean, I could believe all that. It'll all wash out in a year's time, give or take, out of the inflation numbers, which is why the forwards beyond 1 year probably don't reflect a whole lot. Maybe it's a year and a bit, but I'd say beyond 18 months is probably pretty flattish rather than kind of pricing crazy oil prices. So there's still, we still don't know. Inflation's still, like the next inflation report in Canada is going to be pretty spicy, probably the next 2 actually. Gasoline prices were up the most ever in the month, I think. I had 21.4%, I think is what I have in my little thing there.
It feels right.
It's a lot. And I filled up my tank on the
That's
weekend.
why I say that's why I mean it feels right because I know
I filled up my tank on the
folks.
weekend, and I was like, well, Iran's not a great country, a terrible actor. And I was like, I guess like that's a reasonable price to pay to kind of get them from stop them from being bad in the world. Hopefully. That's March. The base effects in April are pretty challenging, coming after last year's carbon tax cut. That's going to push inflation up probably another 6 or 7 tenths in April, on top of the 7 or 8 tenths we're probably going to get in March. So 1.5 on, we're starting at like 1.8. It's it's a very low 1.8, but it's 1.8. So you're in the low threes. You're like 3 to 3.5% in April. That's still a pretty, at least from a headline perspective, challenging backdrop. So as constructive as I am on all this stuff, there's still some risk there. I'm not downplaying that at all. I just think that won't last, I guess, is probably the way to put it. And when the conflict does end, I agree. I think oil prices end up in the $80 to $95 range. I think probably more 80 than 95, but 8 handle for sure. But that means gas prices probably fall, I don't know, 15, 20% from where they're, probably 15 more than 20, or 10 to 15%, let's say. That'll negate a good chunk of the increase that we've gotten. Yep. So it's unfortunate for now. I agree. It does hurt a lot of people out there, which is not great at all. But assuming this ends at some point this month, you'll get most of a reversal in CPI in May, I guess.
We're back to transitory.
I mean, it's a bad word, but I think that's the right one at the moment. Lots of time way over because this is the first episode in way too many weeks, but trade ideas. Anything out there? And the answer can be no, because I mean, I've been kind of dry on trade ideas given the backdrop between the trade uncertainty that's been hanging over us forever and creating kind of really potentially very different outcomes for Canada in the rates market. And then now we have the war, which then also creates potentially very different outcomes for Canada. It's hard to have a super high conviction idea, but I'll listen to what you got.
I think there's still trades you can put on here. I think there's still good opportunity in some of the carry trades you and I have been talking about. I'll go with
carry trades. This guy, volatility just exploded, and he's pitching carry trades.
On carry. Well, some of the trades we've talked about, I still think there's good value in. I mean, some of these are boring, but some of like Ontario June 37s. Yep. I think that's a bond that still has a ton of value. The Canada 37s are very expensive on the curve. We know why. The Bank of Canada owns a lot of them, but at some point, probably about a year from now, there's going to be a new June 2037 10-year Canada that gets issued. That is going to cheapen up those 5s to 37s pretty considerably. Conversely, the Ontario curve is much more normally shaped. Yep. And those Ontario June 37s will have some strip recon value when a new Ontario 37 bond comes out. So I think that will be supportive there. If you actually look at the Ontario 36s versus the Ontario 37s on a curve spread, it's somewhere in the area of like 7.5, 8 basis points of credit pick, which is a lot. That's quite a bit more than you're going to get in sort of 35s, 36s. So I think it's a good bond to sort of own, switch out of Canada 37s to own those Ontario 37s. And that's kind of I don't want to say no brainer, but close to a no brainer trade. Your duration remains the exact same. If we look at other parts of the curve, I think, in the U.S., actually, 7-year swap spreads, 5-year versus 7-year spread of spreads has been very inverted, very, very flat. So I don't mind actually being long U.S. Treasuries, whether you want to swap them back to Canada or whatever you want to do. But U.S. Treasury 7-year swap spread long positions have been unfairly beat up. Similarly, in Canada, 2-year swap spreads look kind of expensive relative to 5s. So I also like being long 5-year spreads against 2-year spreads, putting on some of those asset swap extensions look pretty good. 2s, 5s, 2s, 7s. I also like, if we're doing some rotation trades, I don't mind selling BC kind of in the 5-year part of the curve to own BC in the 7-year part of the curve. BC and 5s trades on top of Ontario, BC in 7s, 8s, 10s, trades at a pick versus Ontario. I think you have to take advantage of some of those picks, even if you don't like the fiscal picture in BC. I'm not suggesting that you roll into BC out of a different province, but I think those relative value trades make sense. And then in the very, very front end, I actually like, we're talking about the Bank of Canada and kind of what's priced in. I think DEES at, 1.8 hikes.
It was a 270-ish when I looked
Right,
last.
270, 275, not necessarily outright, but if you pay something shorter on the curve, I think there's actually a decent amount of slope built into D's. So I don't mind, you and I have talked about this when the first hike could be from the Bank of Canada. We're kind of talking about Q4. But if that's the case, then if D's is really going to get more beat up, I think that something like, I don't know, pay June, pay September. You pay September to receive Dees. I think some of those trades look good because I think Dees is unfairly cheap on a relative basis.
Fair enough. Lots of ideas. Geez, I shouldn't have started with this is hard. I'm like,
this is hard, but
I'm a shameful person. I just need to talk to Adam more apparently. I think opportunities will come over the course of the month, like April. The Provi calendar opening up and issuance starting is I think going to drive opportunity. I think if Provi spreads widen anymore on the back of all the issuance, I think they're probably a buy there. Again, this too shall pass, and the Provi picture still looks good. Every province on a relative basis, honestly, they're really all not that bad. It's about some of them are deteriorating relative to where they were, but from a global perspective, still in very good shape, still very attractive globally. So that's not going to change anytime soon. The only thing I'm keeping an eye out for, we will get a fiscal update from the government of Canada at some point in the next couple of months. It probably won't be this month because they probably would have already told us, but you never know. Sometimes it's a little bit shorter notice than otherwise. And with that will come some kind of update on issuance. I'll just be watching for any changes there in the long end, and how that could impact 10-30s curve and just the long end generally. That's an important dynamic to keep in mind. The budget last year had long issuance holding steady from last fiscal year to the fiscal year that started today, whereas 2010s are a little bit lower. So we'll see if there's any update on there. Something to keep an eye out for in the next few weeks. And I think we'll leave it there. Longest episode ever, but sometimes that's the way it's got to be. When
the listeners, they wanted it.
We'll find out with all the hate mail I might get. But good luck out there. Hopefully all this chaos ends pretty soon, and everybody turns out okay and does manages to escape this with at least their jobs, I guess. I don't know. Yeah. So good luck, and Adam, thanks for coming on the show.
Oh, thanks a lot for having me, Ed.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.